a little bit of time left to put your polls in, but if you can complete those, that would be great. Thank you very much. On behalf of the National Bank of Fujairah, I'm pleased to welcome those of you that have been with us for years, as well as those of you who are joining us for the very first time. The theme of today's event is Fundamentals of Planning Your Investment Journey. This webinar is part of a wider investment awareness initiative by the National Bank of Fujairah, where our aim is to increase awareness of how important savings and investment are and what all potential opportunities are for you. In the pursuit of our personal and professional goals, we usually discover that there is no time left to effectively manage your wealth, savings, and a better word, investments. In today's session, while we'll be helping you to identify some very basics and fundamentals of how to plan your investments and how to start your investment journey as early as possible, we will also help you know about the National Bank of Fujairah's investment management proposition and how we can help you achieve your financial aspirations through an easy-to-understand investment solution that addresses your specific needs and objectives, allowing you to focus on your day-to-day responsibilities. Together with me, I have Haytham Abdullah, CFA, on the panel today. Towards the end of the webinar, we will also have a Q&A session. So in case any questions come to your mind during the session, please share them through the Q&A tab and we will address them at the end of the session. We hope that you will find today's webinar insightful. Over to you, Haytham.
Thank you very much, Gavin. Welcome to everyone who is joining us today. Of course, like Gavin, like you mentioned, there are many reasons to invest. You might be planning for your retirement. Maybe you want to keep some money aside for your children, or you might just simply want your savings to grow. But we're here today to talk about the next step, which is how to go about investment, how to actually build an investment strategy that's optimal, that's right, and puts you on the path for success as an investor. Today, we will discuss 5 of the main elements of building an optimal investment solution. First, your investments should align to your risk profile and objective. Should also be well diversified. You might as well have it professionally managed. You also need it to reinvest to compound the returns. And of course, finally, you need to have easy access and proper liquidity to your investment. Let's take the first element, the right allocation. So as we understand that there are multiple risk profiles for each investor. There is no right or wrong profile. You could be conservative, you could be moderate, or you can be aggressive. It's about the right allocation for you, the right allocation for your financial situation, the right allocation for your goals, and the one that matches your financial circumstances. There are different elements that determine what your risk profile should be, such as your age, your income level, how much money out of your wealth are you investing, also your investment experience, and even your personality. Gavin, earlier today we've asked our audience to answer a poll about whether they are conservative, moderate, or aggressive. Can you share with us what the results have been?
Thanks, Haytham. I think we're just waiting for a final couple of polls to complete, so we can probably come back to this question very, very shortly. But I think it'll be very, very interesting on the spread.
Sure. What we can do in the meantime is to define what each profile means. So when we talk about a conservative profile, here we're talking about someone who prefers to take low risks. As we understand, we have bonds that are low risk, but also offer lower returns. So typically you would see a conservative investor allocating most of his investments into bonds. On the other hand, stocks are typically more volatile and more risky, but potentially offer higher returns. So you would see an aggressive investor allocating most of his investments into stocks. And of course, you can always be in between. You can be balanced, have the right balance between stocks and bonds. It could be even split 50-50. So let's take a few examples of how to actually determine your risk profile. In this example, we have Alia, a senior accountant, 35 years old. She has relatively stable income. She has kept 12 months of her expenses saved up as emergency cash. Now she's looking to set up an investment for her son, who's 6 years old. She's planning to invest $1,000 on a monthly basis. Basically, the $1,000 represents less than 15% of her income. She's looking to invest until her son is 21 years old. In this case, Alia has the capacity to take an aggressive allocation because she will be investing for over 15 years. She's also financially stable, so in case of emergencies, she has enough savings to fall back on and wouldn't have to tap into that investment. What she can also do is, as her son comes closer to 21, she can shift that investment to a more conservative allocation to avoid any fluctuations in the investment value. Let's take another example. Here we have David, 57-year-old director working in a bank. He's actually looking to retire in 3 years. He's looking to invest $2 million in an investment portfolio, and he will use that investment portfolio to redeem from. Basically, he will sell part of that portfolio or use the return from the portfolio to cover his living expenses when he retires. Now, that investment portfolio will represent 80% of his wealth. So David should have a very conservative portfolio. He's basically focused on generating a decent amount of returns, some returns, but is mainly concerned with protecting his investment. Gavin, I believe the poll results are out with us. Can you tell us more about the risk profile question?
Yes, thanks, Haytham. So yeah, just in answer to obviously the first question, I'll just go back to, because we have the results in now. It's interesting that just over a third of the respondees are actually either new to investing or just starting to learn about it, which obviously is great in terms of them taking that first step. In relation to question 2, which is around the conservative, moderate, or aggressive growth, you probably find that roughly 30% of respondees are in the moderate section, again with more people skewed towards the conservative section, which would highlight again it's people within the new investing section.
I think what this tells us is about also the demographic of our audience. See, what we have learned is that people at a younger age, especially when they start investing small amounts, they can afford to be aggressive, and they typically are aggressive in their investments. However, as they grow older and come closer to retirement, they would shift more to a moderate and then finally to a conservative approach. Kevin, also one of the questions we asked the audience was that which asset class do they prefer? Can you tell us more about the results?
Thanks, Haytham. So most of the people, the respondees, again, about 30% are looking at stocks as one of the main options. Real estate is roughly around about 15%. So it's mainly really those two that really have, I guess, the significant amount that people are looking for.
I guess, again, that also relates to the profiles that we've just discussed. Also, it adds to the fact that stocks and real estate are one of the most popular investments and well-known investments around, as opposed to bonds, which people are less familiar to than stocks and real estate. Now, how does David, that we just discussed him in the example, how would he go about in building his investment? Is he going to pick stocks? Is he going to pick bonds, real estate, or cash? The correct answer should be all of the above. He should have a well-diversified portfolio. We always hear this, don't put all your eggs in one basket. Think of it this way. If I put all my investment into a company or into an investment or a stock, and God forbid something happens to that stock, I would be impacted significantly and probably will take a long time to recover from that loss. So in essence, diversification reduces your risk, allows you to recover from downfalls and volatility in the market. It enhances your long-term return. There will always be economies. There will always be investments that do better than others in different years. Markets and asset classes tend to outperform each other every year. So the best approach is to diversify. Now, there are three different types of diversification that we will discuss here. One is asset class diversification, meaning that my investment would be composed of stocks, bonds, a bit of real estate, maybe some fixed deposit and saving account, and perhaps commodities and other asset classes. Next, I want my investment to be geographically diversified. I don't want my investment to only be in one country. Even if it's my home country, it's always better and more optimal to have a diversified approach. So I would invest a bit in US, a bit in Europe, a bit in Japan, a bit in GCC, and have a well-diversified portfolio. In addition, I can also diversify by sector. What I can do is have part of my investments in the technology sector, healthcare sector, consumer goods sector, energy, and so on and so forth. One of the best methods to diversify is actually by using funds. Now, mutual funds are simply baskets of investments that are managed by a professional fund manager, and that fund manager follows a specific investment strategy. Now, using a fund is very useful, especially when you have smaller investment amounts. Think of it this way. If I have a small amount to invest, there is a limit to how many stocks I can buy. But with that same amount, if I just buy a single fund, such as an ETF, I would get much more, a wider diversification. Using funds also has another benefit, which is having access to a professionally managed investment. See, for investors who may not have the time or experience to manage their investment, using a fund manager is far more optimal. Basically, an engineer or a doctor is more focused and more specialized in his field of work. We cannot expect him to perform as well as a dedicated and experienced investment manager who's researching the market day to day, who's monitoring the market day to day, managing the investment, buying what he thinks could be profitable, selling where he thinks he should exit, and all of that, on the long run, yields better results than trying to manage the investment yourself if you don't have enough time or enough experience. This is specifically important when you are trying to diversify your investment globally. Think of it this way. I'm sitting here in Dubai, and I would like to allocate part of my investment to Japan. I'm not as knowledgeable in the Japanese market as a fund manager who is sitting in Japan. He's well experienced, he knows the companies, he knows the economy, he can identify where opportunities are and invest in them. To even make it better, what I can do is I can allocate part of my investment to the fund manager in Japan, allocate another part, for example, to a US stocks fund manager, maybe perhaps put some money with European bond fund manager. And this would give me a portfolio that is diverse and professionally managed for me. Gavin, I have a question for you. Would you prefer your investment to pay you regular income or to grow over time?
Yeah, thanks, Haytham. I think it depends on on obviously my situation. I think for me personally, I want to try and make the most out of the funds invested. So to get them to constantly, be reinvesting is great. If I was to look at my father, though, he's obviously into his late 50s. I think it's slightly different. He actually is more looking at taking some of the funds out that he can utilize to live his lifestyle. So it depends on my situation.
Thank you, Gavin. See, from our experience, we noticed that a lot of investors prefer having regular income. But from an investment perspective, to truly maximize your returns, you want to compound and reinvest your profits. See, we always hear the term compounded interest, compounded profit, compounding effect, and how it can maximize and grow your returns. What it simply means is that basically, rather than taking the profits and the returns out of your investment, you reinvest it back and let it grow over time. What this does is basically you don't only earn returns on your principal amount or your initial investment, you also earn profit on the amount you just reinvested, which is the profits you generated in the years before. Let's see through an example. Here we have an example of an investment where you start with $100,000. The rate of return on this investment is 6%, and you're planning to stay invested for 15 years. Now, account number 1, returns are reinvested, while account number 2 simply takes the returns out and keeps them on the side. Let's compare the returns. In year 5, account number 1 has grown by 33% compared to account 2, which has grown by 30% only. Of course, as we progress through time, the compounding effect grows larger and larger. We can see that in year 10. Now, account number 1 has grown by 79%, while account number 2 has grown by only 60%, an additional 19% of returns due to the investment. This is very significant the more and more you proceed through time. Just look at the returns at year 15. Account number 1 has grown by almost 140% compared to account number 2, which has grown by 90%. You can see that there is an additional 50% of returns generated just from the fact that we have reinvested our profits back into the investment rather than taking them out as a dividend or as coupons. Now, one way for us to reinvest and benefit from reinvestment is by using funds. This is very important, especially when you have smaller investment amounts and you're trying to buy things, you're trying to invest in things such as real estate or bonds. Think of it this way. If I buy an apartment, at the end of the year, I would get my rental income. It would be very hard for me to take that rental income and buy another apartment with it. But what I can do is I can basically put it into a real estate fund or a bond fund in the case of bonds, and basically the fund manager would reinvest my returns for me. Now, in certain cases, like you mentioned, Gavin, there are people who would require an income-paying investment, an investment that pays them cash. So this brings us to our next point, which is the liquidity of your investment. Liquidity simply means that how fast can you convert your investment into cash without incurring penalties or a discount in price. One important point of liquidity is the ability to do partial redemptions of your investment. Let's take the real estate example again. Imagine you had a villa and you needed to get a small amount of cash to cover an expense. You either have to sell the villa as a whole or keep it. You're not able to sell part of that villa or part of that real estate. However, when you have a portfolio in stocks, you're able to sell part of that portfolio while keeping the rest. You sell part of it, you cover your expense, and the rest remains invested. And here we have examples of different liquidity levels of different assets. For example, when you have your investments into deposits and saving accounts, that's something that's very accessible. You can basically immediately get access to that and take the cash out. If you're invested in stocks, typically it would take a day or two to sell your stocks and then take the cash out. With mutual funds, it typically is less than a week. However, when it comes to real estate, it could take you several months to sell an apartment or a villa or a part of real estate. Going to private equity or starting up your own business typically takes 5 to 7 years to exit and cash out of the investment. As you can see, all of these elements in investment are so important that what we've done here in NBF is we've taken all of these elements together and have built an investment solution that is globally diversified. It allocates to top fund managers that invest in the equity and bond market. We also offer a wide range of portfolios with different risk levels. We also provide the flexibility for the portfolios to be redeemed on a weekly basis with no lockup or exit fees. Again, like we mentioned, the liquidity of your investment. And finally, we made this investment very accessible, where you can start investment with as little as $10,000, or you can basically contribute $1,000 on a regular basis, such as monthly basis or quarterly basis. Gavin, I'm sure many of our audience have questions, so let's move on to the Q&A session.
Thanks so much, Haytham. And yeah, what a fabulous description that was. I think it gives the audience a really good understanding from those that are relatively new to investing, how you can start off, what you should be aware of from diversification, and also to understand where you are in your goal and maybe your life cycle. I think there's some really good points in there. You mentioned about people can start from $1,000 per month. There's no lock-ins, and obviously it gives them that spread, which, given what's going on in the world at the moment, I think is really, really critical. So again, great presentation. Before we go to the questions and answers, for the audience, that there should be another poll that's going to come up. It's very much just going to ask you about feedback on this presentation today, but also some preferred topics that are coming up with future timings. So if you're able to complete that poll, that would be great. It's obviously for us to be able to make sure we can accommodate you next when there's that particular topic or obviously timing as well. So just on some of the questions, Haytham, and obviously, like I said, great presentation. One of the questions that has come up, and I think it's very relevant, is very much about concerned around the timing of the market. And I think if you take into account, obviously today is US election, you've got Brexit, you've also got obviously the COVID. One of the questions is now the right time to be investing?
That's a very interesting question, and that's actually one of the most common questions that we get, whether it's the right time to invest or not. See, the right time to invest is actually today. Some may even say the right time to invest is yesterday. As we've seen from the reinvestment slide, the earlier you start and the longer you allow your investment to grow, the bigger your profits and your returns would be. See, it's mainly about time in the market rather than trying to time the market. From our experience, there will always be fluctuations, there will always be risks. Markets are always volatile, will go up and down. There is always something happening. Today it's the election. A few months ago it was COVID. A few years earlier it was volatility in oil prices. There are always factors affecting the market. However, what we've seen is if you deploy the right investment strategy, if you are well diversified across sectors, because like we said, things will happen and some sectors will outperform each other. So you want to have the diversified approach. If your portfolio is aligned with your profile so that you don't have to sell in a time where the market is down. These are some of the things that keep your investment portfolio healthy even in times of stress or times of volatility like this. Volatility coming from things such as the election are typically short-term in nature. Think of it this way. When you invest in a business, is the person sitting in the White House affecting your business or not? That's the question we should ask ourselves before investment. And most of the time, the answer is no. Thank you, Gavin.
Yeah, thanks so much, and great feedback. And I think that's why it plays well for the investors when it's around mutual funds and obviously geographical spread, because it takes out the volatility nature that you've mentioned. So yeah, I think that's very valid. One of the questions has come in from one of the participants. My money is safe in a bank and it's earning good interest or obviously profit. Why would I invest some of this?
The answer to that is quite simple. At the moment, we can see that fixed deposit and savings accounts rates are close to 1%. And when we think about savings, we're basically talking about cash that we might use in 5, maybe 10 years. If we go back in time, let's think 10 years from now. Think about 100,000 dirhams. What could 100,000 dirhams buy you today versus what it could have bought you 10 years ago? Now think 10 years ahead from now. Of course, prices of goods or the purchase power of your cash decreases with time, and that's mainly because of things such as inflation. So the main reason to invest and have your savings grow is to protect yourself from inflation. Thank you, Gavin. Thanks
very much. Great feedback. Another question in from one of the participants. My situation is, so they're saying they've got an investment portfolio, but their goal that they originally set has now actually changed. With relation to the MBF management product, can they change, I guess, their investment plan easily?
Okay, let's answer this question first from a general sense. You shouldn't change your investment strategy or profile just because the market is going up or down. You should change it only when your financial situation changes. For example, if one was in a moderate portfolio and suddenly he has extra income and he would like to deploy that, I think he would be okay going into a more aggressive allocation. If it's the other way around, that suddenly he has some additional expenses or liabilities, it would be better for him to move to a more conservative allocation. In terms of MBF solutions, yes, we do allow our clients and investors to change their plans whenever they feel it's necessary. However, we don't recommend it unless it's dictated by a change in their circumstances.
Great. No problems. Again, another participant just come through. They said they're asking a question again relating to the MBF product. They're looking at pulling out some of their profit from their investment profile. Is that possible?
Yes. Again, that plays into the liquidity element of an optimal investment solution. As I mentioned, that we've made our investment solutions flexible and liquid that you can redeem on a weekly basis. See, once you have your investment portfolio grown and you would like to take some profit out or to take some cash out to meet some expenses, you can always do partial redemptions out of your investment.
Great. We've had a couple of questions in here, so I'm just going to fire away. Is it advisable to split a portfolio into different risk sectors with perhaps a smaller piece into a higher risk section?
Can you repeat that again, Gavin?
Sure, no problems. So one of the questions is it advisable to split a portfolio into different risk sectors with perhaps a smaller piece into a higher risk sector?
Yes, definitely that's possible. What you should effectively be concerned about is your overall profile. So let's say I have 100,000 dirham to invest, and I put 30% of that, or 30,000 dirham, in an aggressive portfolio. Then I put 70% of that in a mix of a conservative portfolio and some cash deposits. Effectively, my 100,000 is allocated in a conservative manner. So in the end, it's about your overall allocation and not just the smaller pieces that you could allocate more aggressively or less aggressively. Thank you, Gavin.
Great. We've probably got time for another, I think, 4 or 5 more questions. So one of them has come in. I realize that bonds have very low returns. Why are they still attractive to some investors?
Yes, because bonds are typically valued relative to the deposit rates, basically. So if a deposit rate is giving you 1% and a bond is giving you 2 or 3%, you have an incentive to basically take some risk and invest in bonds. Of course, when it comes to bonds, it depends on the credit rating or the credit quality of the bonds. Some bonds generate close to zero and even negative in certain cases, and other bonds go up higher to 6 and 7 and above that if they have lower credit rating. So yes, I would say it would still make sense to have some allocation into bonds. Again, that all depends on your risk profile.
Great. Question coming here. Are the investments in MBF halal and comply with Islamic law?
Yes. So basically our investment proposition, like we said, has a wide range of portfolios. We have conventional investments and we have Sharia compliant investments as well.
Okay, very good. If I have agreed a monthly contribution, if I have a need due to an emergency, can I stop the payments for a short period? And I think this is in relation to the NBF product.
Yes. So in relation to the NBF product, yes, you can stop or pause or just completely cancel your contributions whenever you need to do so without any penalties or some kind of exit fees or any penalty on yourself.
Okay. We've got a question here from a beginner investor. They're asking, for a beginner investor, what would you say would be the correct investment strategy? Would it be wise to invest in bonds or stocks, keeping in mind that one doesn't want to take higher risks?
Okay, yes, that's a valid question. Like we mentioned in the beginning, stocks and bonds are the main elements of most investment strategies. They are also the most liquid and have been researched the most and has been providing the best return to risk rates over a very long period of time. So yes, you most probably you would allocate most of your investment to stocks and bonds. Now the next question is, how much are you going to allocate to each asset? Now that depends on your risk profile. And like we said, your risk profile is determined by your own unique situation. So to fully answer that question, I would have to know and understand the person's own financial situation, and then we would be able to determine the risk profile. See, one of the things we do here in NBF for new investors is that we sit with them and understand their financial situation, what kind of income, what kind of returns they're looking for, any liabilities, any upcoming expenses, in the case of retirement planning, what kind of retirement lifestyle they would like to have. And based on that, we would suggest the optimal risk profile.
Great. If I have an investment, if I invest and my investment drops in value, I guess one of the questions I would like to know is, how do you recover from that? Because obviously, you can get very worried about that yourself. So how do people kind of recover from that situation?
Okay, so we've implicitly covered this question in the slides when we said that imagine if you invested in one stock or one company, and God forbid something goes bad and it goes down, it will be very hard to recover from that. However, if you are well diversified, so rather than having one company or one stock, you have hundreds of stocks in your portfolio, stocks tend to recover over a long period of time. So it's the diversification that protects you. What you should think about when you're concerned about how do you recover from declines in the market, you should be concerned about this before it happens. So you should be prepared for this before it actually happens. And how do you prepare for that? By being well diversified. Thank you, guys.
Great. There are different risk profiles. How do I know which one is the right one for me? Obviously, you talked about aggressive, moderate, conservative. How do people really know which one is the best that suits them?
Again, like we said, it all depends on your personal financial situation. In general, there are a couple of I would say, guidelines to this. Typically, when you're young of age and have a long investment horizon, you have the capacity to go a bit more aggressive versus when you're older of age and would like to retire with this investment. Another factor is how much money out of your total wealth you're investing. If you're investing a significant sum of your wealth, then yeah, definitely you would be more conservative. However, if it's only a small amount of your income or a small amount of your wealth, you'd be able to take more risks with that.
Last two that have come through. I know on the call there's a lot of, on the presentation webinar, there's a lot of people who are obviously new to investing or just trying to get into it, but there's also people that are a little bit more experienced. So this next question probably maybe bodes to them a little bit. One of the questions that's coming is, I like to invest myself. Why should I use a fund manager? And what does it cost to use a fund manager? I think that latter part is in relation to the NBF.
Okay, that's an interesting question. And that comes a lot. See, Gavin, let me ask you back a question. Have you tried investing by yourself?
Actually, funny enough, yes. So I know a long time ago when I was back in the UK, I tried investing myself in I think 4 or 5 different stocks. It was very hit and miss. I remember one stock that I got, Royal Mail, it did very, very well, but there was others that literally didn't go very well at all. So it was certainly a lesson learned, I can tell you, because I didn't have the time, I think was the biggest problem. Over to you, Haytham.
Okay. I think we've lost connection on your last part, but I got most of your answer. So basically, yes, time is one of the key elements in managing an investment. See, managing an investment is a full-time job. You need to be always in the market when you're doing it on your own and basically managing your own portfolio of stocks and trying to select and buy and sell stocks. This is typically a full-time job. You need to be dedicated, you need to have the time, and you need to have the experience. All of these are things that a fund manager does for you. Now the next question is, how much do I have to pay that fund manager? Most importantly is you should think of what kind of returns you're expecting from that investment. You don't want to overpay for a fund manager. You don't want him to take most of your returns. You want to pay him the right value for what he's giving you. So that's the main point to assess whether I should use an investment manager or whether I should invest by myself. Think of it this way. If I'm investing in a conservative portfolio, for example, and I'm targeting 3 to 4%, it wouldn't make sense for me to pay 2% to get that investment. Is that right? However, if I pay 1% or less, this would be reasonable. On the other hand, if I'm targeting a more aggressive and much higher returns, and I can see a fund manager or an investment manager that can deliver consistently these returns and has a solid track record, I'd be more than willing to pay him an extra management fee. So these are the main elements when assessing whether to use a fund manager or investing by yourself. Another thing, Gavin, is that historically what we've seen is that over 90% of regular individuals that try to manage their own stock portfolio end up underperforming the market. Actually, some of them lose their investments in the first 2 or 3 years, and they fall below the market. However, investing with a fund manager, this is much less likely to happen. Thank you, Gavin.
Thanks, Haytham. So I think that's a lot of the questions that have come through. In summary, Haytham, what would you like to do, as an overall probably points for people to be aware of, to take away from this? If we were to pick 3 or 4 valid points, what would you sort of suggest to the participants listening?
I think the 5 main elements that we covered are some of the main ones, but I would add to them, again, that's in relation to the first question you asked, which is this the right time to invest? My advice is don't try to time the market. Statistics tells us that when you invest and generate returns, over 98% of these returns are because of the fact that you've invested early and you made the right investment and you diversified. You have basically 2% chance of success if you're trying to time the market. From experience, I can tell you, and given a lot of investors that I've met and discussed these with, most people will try to wait for the right time to invest, but end up always missing that time to invest. It's very hard to know when the bottom in the market is or when the top is. So it's always better to just simply diversify, protect yourself against this volatility, and invest. Another tip I would add is if you're worried about the markets and the volatility and all the risks and everything that's going on, a very simple strategy to deploy is rather than investing all the money at once, so let's say I have $10,000 to invest, rather than investing it all at once, what I can do is I can split it into staggered contributions. So what I can do is I can invest $1,000 on a monthly basis and basically ride out the volatility of the market. I could basically average out my cost of investments. So that's one of the ways to deal with the risk and the uncertainty of the markets. Thank you, Gavin.
Thank you very much. So I think that brings very much a conclusion to the investment proposition today and the webinar. I hope that everybody has fully enjoyed it. As we mentioned, for those of you that have not completed the question on the topics that are coming up next, please feel free to poll that so that way we can get an idea, as well as obviously the timing. So thank you very much for that. So again, Haytham, thanks very much. I hope everybody enjoyed it. Please, everybody else, remain safe. Have a great rest of your day, and please look forward to the next investment event that will be coming up shortly. Please keep an eye on the email. And again, from everybody at MBF, thank you very much.
Thank you, Gavin.